in the mortgage market? Join us for another episode of FDM Brews to learn more about trends and updates in the mortgage industry that can help you get your clients pre-approved for the home of their dreams.
Cheers, Brett. Cheers, Natesh.
Cheers, Cindy. Great to see you this morning.
Great to see you as well. Getting caffeinated, seeing what's brewing in the mortgage industry.
That's right. There's a whole lot brewing.
Inflation's the big word that's floating around right now, and in the real estate industry, I don't know that all agents really think of, okay, let me call my mortgage guy, right? Let me call a mortgage company because they're focused in on cash, and cash is king. But man, there are ways that you can leverage your assets and really think about your house as an investment, right?
Absolutely, Cindy. Cash has been king over the last 2 years, right? Cash wins the contract. We know that. 2022 is a very different environment. And as we shared before, we do a lot of work with financial advisors. And paying cash might be the best way to win the property, but it might not be the best way to build your financial foundation. And you brought up the concept of leverage, right? Leverage is one of the most effective financial tools that really smart money people use to build their financial future, right? Warren Buffett, right? Everybody knows who Warren Buffett is, one of the smartest investors in the history of mankind, right? He talks about leverage all the time. And why we pay cash for our property, and that might be the best thing to win the contract, it might not be the best financial strategy for our clients, especially in this rapidly inflationary market we're dealing with today, right? So we might have to change our thought process. So what we want to talk about today is how do we leverage it? How do we take that real estate asset out of its silo and integrate that into our financial plan? And one of the new concepts that we've seen over the last couple of years, which is really important today, is delayed financing. And that's what we want to talk to you about today.
Absolutely. Well, let's dive in here.
All right, let's get going. Let's talk a little bit about delayed financing.
Sounds good. And Cindy, as you said, cash is king, and that's what we've seen over the last couple of years, especially. And we've been talking to some of the agents over at Downing-Frye and to Mike, and we've heard there have been months where there have been over 80%, sometimes even over 90% of the transactions that have been cash purchases. Which historically is unheard of. But how do we get around that, or what do we do with that investments? There have been buyers, finance buyers that have been squeezed out of the market by investment firms and hedge funds. 35% over the last 2 years in S&P 500 has made many buyers flush with cash, and also folks from the Northeast who are selling their homes, in New York, Boston, they're selling their homes for high prices, and they're moving down because the workforce has changed, right? And folks are able to work from anywhere they want now. Many companies have gone 100% remote. So why work in Boston in the middle of winter when it's snowing when you can work from Florida? Right. So they've been buying, and they've been taking that cash and buying in Florida. 30% over the first 4 months of 2022 have been cash purchases. 4 out of those 5 markets that have been cash heavy are down here in Florida. Yeah. And here you can see, so out of the top 5, West Palm Beach, Naples, right here, and Northport and Port St. Lucie, all been cash heavy in purchases.
Yeah, it's amazing. Natisha brought it up that a lot of people sold with tremendous equity in the Northeast corridor, right? And they've built rapid equity, and they've taken that down, and they've used that to buy cash in Florida, which has put pressure on the market.
Yep. So now what do? So you paid cash to get the contract. Now, is this the right move moving forward financially? Everything is in one basket. You've paid cash. Now you have an asset, a home, but your cash is also tied to that asset. Changing markets require changing thought processes. Big word we've been hearing, like you said, Cindy, inflation, right? Now, with inflation, what do we do with the cash that's tied up in that home?
That's really important, Cindy. It's not going away, right? So we've reached a 4-decade high in inflation. It is going to get worse, right? I wish I could tell you different. Like we took, we don't want to focus on the negativity. We want to focus on how to approach it. But gas prices have reached record price per gallon levels, right? Today was $4.59 a gallon. That is the first time national average has been over $4 in the history of the United States. Oil futures are pointing to a $200 per barrel. Right now, we're at $126 per barrel as of this morning. Food prices have increased rapidly as well. You can't go into the grocery store without noticing that food has inflationary pressure as well. Obviously, the Russian-Ukraine conflict is exacerbating inflation. Unfortunately, it's going to get worse. So what we need to do is help our clients understand, how do we protect our assets against that? Now, as I shared with you, July 21 to April 2022, 8.5% inflation, 8.3% inflation in April 22. That's the highest rate of inflation in 4 decades, since 1982. We see that, we feel it. Now, we have been relatively isolated from inflation over the last 20 years. We haven't really seen that. So this is kind of a new phenomenon for us. So we're facing a 4-decade high. And so what does that matter to real estate? Well, it means we have to help our clients, right? What we want to do is help them buy a house. That's great, right? We want to help them sell a house. That's great. But we also want to be cognizant of what's happening in the marketplace and help our clients and give them solutions that are affecting them, right? So we all hear about asset allocation, right? Asset allocation. It's a very famous asset allocation. I do a lot of work with financial advisors. And what's interesting is they think about asset allocation when they think about mutual funds and stocks and savings bonds, blah, blah, blah. But we tend to take our real estate and put it on our own silo, right? So when you work with financial, it's my house. Okay. Well, historically, 67% of the average American family's net worth is where? It's in their real estate. It's their single largest asset. It's the single largest thing that drives their financial future. However, we tend to put it over here in a silo. Mm-hmm. I paid cash for my real estate. What's my real estate? Okay, well, now you have all your eggs in one basket, right? You have 2 assets now into 1 asset, right? So we need to bring that real estate into what I call a coordinated asset strategy that helps people. And it's really more important now with inflation. So asset allocation needs to include your real estate, and we tend to put it over here in a silo. What we want to do is bring that back into discussion because it's the better financial decision for our clients. As I shared, 67% of the average American's family's net worth is in their real estate. And you can look at that by age bracket. Real estate is our largest asset, but we don't include this in our overall asset allocation strategy. And we want to help our clients understand that. They pay cash. That's great. They pay cash and they forget about it. Wait a minute. Now I've got all my cash in my real estate. So I'm not allocating my assets, and inflationary defense strategies, that might not be the right strategy. So when I pay cash, what am I doing, Cindy? I'm taking 2 assets, right? Cash is an asset that could be invested elsewhere. Could be in the stock market, could be in a mutual fund, could be in bonds, could be in life insurance, could be an annuity. Now I'm going to take that cash and I'm paying cash for my real estate. So what have I done? I've taken all that cash and I've put it into real estate. Real estate's an asset. Cash is an asset. Now I've taken 2 assets and turned them into 1. If I take all my cash and put it into real estate, all of my assets are in 1 asset, which is the real estate. Right now, my real estate is going to go up or down in value, regardless of what cash I have into it or what mortgage I have into it. It is now all of my assets are tied up into 1 asset. Now, we hear about this all the time. Asset allocation. Well, I'm not allocating any assets. I'm just buying real estate. I'm taking my cash. I have no asset allocation to protect me against risk. And inflation now is the risk that we're worrying about. So I've just kind of moved all my money into 1 asset, and it's sitting there in what I call dormant equity, right? It's there, but it's going to go up and down in value regardless of what my mortgage balance is, right? My house will go up in value or down in value regardless of what I owe on it, right? My equity may change, but my asset, right, is going to go regardless of what my cash invested or my mortgage balance is. Now, that brings us up to opportunity cost. Opportunity cost is the value, the second best choice, or what you gave up to make a decision. So what's my opportunity cost? If I take $300,000 right out of the market and I put it into cash, Cindy, what did I lose? I lost the opportunity for that $300,000 to make money for me, right? Because where is it sitting? It's sitting in my real estate. Now, my real estate is going to go up in value regardless of how much cash I have in it, right? It'll go up and down in value. If I paid $300,000 in cash and the property drops to $250,000, my cash is still tied up. My real estate value went down. If I paid $300,000 cash and it went up to $350,000, my cash value didn't change. It's still $300,000, right? But I made $50,000 on the real estate. However, if I took $300,000 out of the stock market or an insurance policy or an annuity, right, I've lost the opportunity for that $300,000 to make money. This is a concept all of us use every day without knowing it. Each time we make a choice, we've chosen something else. What is that opportunity? Now, I always talk about following the smart money, right? So who does inflation value? It values benefits Wall Street. What does Wall Street do when inflation happens? They borrow the bejeebas out of money, right? What do? Inflation happens. They borrow money. It's a concept called inflation adjusted value. They borrow today and pay it off with cheaper dollars. What does inflation do? Inflation devalues the dollar. So if I borrow today, when the dollar devalues, as it does with inflation, right, then I pay it off with future dollars. So when you watch this, right, inflation hurts the average American, hurts us, right? Everybody on this phone call, inflation is the greatest tax on wealth. We'll see. It even exceeds the government taxation. Inflation is the worst tax on wealth we can see. Wall Street and higher net worth buyers, inflation doesn't impact them. They borrow more money, right, at cheaper dollars and pay it off. Not to get too complicated, but the smart money borrows in inflation. So Forbes, for example, recommends getting a fixed mortgage that is as long-term as you can get. You're making inflation work for you. Some homeowners are buying money for 30 years and paying less than 5% per year. Okay, even if you're paying 5 to 6% per year, that is before taking into consideration the tax deduction on interest expenses. The very best thing about a mortgage is that is an inflation-adjusted value of your mortgage payments decline at the same rate inflation rises. What does this mean? As inflation rises, my mortgage payment actually becomes cheaper. So what do I want to do? It seems counterintuitive. With inflation, I actually want to borrow more. So what happens to people that pay cash? What's inflation doing? It's eating their cash, right? Their cash is becoming less valuable and it's tied up and we can do nothing with it. So I want to liberate that cash and move it into something that can help me build value. Rick Edelman, if you haven't read any of his books, he's a nationally known financial advisor. He has a great book called The Truth About Money. It teaches us that asset allocation includes your home and paying off your mortgage, or paying cash, Cindy, is really not the best strategy. Homeowners need to maintain liquidity. If you have a financial emergency, cash reserves are essential. Homeowners who pour every dime into paying off their mortgage early might not have a cash cushion. You've essentially buried the money in the walls of the house. How many times have we seen people pay off their house, then they have an emergency, and what do they need to do? They need to scramble to go get a loan or a reverse mortgage to get the cash out. The problem is a lot of times when they have that emergency, it might be lost a job or something else. It makes it more difficult to get what, Tish?
A loan.
A loan, exactly, right? Wait a minute, I paid cash, but then when they need the money, you lost your job, so you need the money. I can't go get the money because I can't get a mortgage, right? So a mortgage doesn't affect the home's value. The house itself doesn't care if it has debt on it or not. Over the long term, it's likely to appreciate regardless of the amount of money you owe on it. And that's true, right? If I buy a house, I owe $300,000 on a $500,000 house. That house is going to go up or down regardless of what my mortgage balance is, right? That asset appreciates or declines in value independent of what's owed on it. Mortgage interest is inexpensive because the mortgage is secured by the value of the home. Interest rates are much cheaper than credit cards, personal loans. The interest you pay may be tax deductible, and it is likely the cheapest money you ever borrow. Now, one of the things that cracks me up, Cindy, I'm paying off my mortgage as fast as I can at 5%, but I'll go charge things on my credit card at 22%.
Yeah, that's a bit ridiculous.
How does that work, right? So we're accustomed to do things and we don't think of these things, right? I should be paying off my credit cards at 22% that's not tax favored and leave money on my mortgage. Mortgage payments get easier with time. They're often a budget stretch for young homeowners, but with a 30-year and fixed mortgage, time is on your side. The effects of inflation and growing income make that payment decline, right? Inflation also drives what? Wage increases. So if my fixed payment is this, but inflation's pushing my wages up, I'm actually paying off my mortgage again with cheaper dollars. Investments that outperform the interest cost of mortgage over long term, that scares some people. However, over the long term, right? I'm not advocating 100% stock investments, but rather a diversified mix of investments built for a 30-year time frame. It might be an insurance policy. It might be an annuity. It might be another strategy where I can take that cash and invest it in something that's giving me a greater return than my interest rate. I teach a class how banks make money, and this is your personal strategy. What banks do. Cindy, you give me money, and I'm going to pay you a whopping 0.5% as a bank. Woo, yay, but it's safe, right? But then I'm going to lend it out at 5% or 6%, right? And make that spread. Well, it's the same thing that individuals use, right? It's a concept of leverage. I might borrow at 5 to after tax adjusted at 3, but if we're earning 4 or 5 or 6, I'm making money just like banks do. The banks don't tell you how they make money because they want to have the biggest building in the city. And if they told you how to do that, they wouldn't have that, right? So it's the same thing. How do I take what banks do and use that in my own personal strategy, right? There's a book called Be Your Own Bank, and that talks about how we do that. And it's even more important today in an inflationary time frame. So, Tish, I paid cash. Now what?
Yeah, so your cash is now tied up in the property. What do you do with it? So as Brett mentioned before, you take cash, which is one asset, real estate, which is another. You combine into two. Now you have one asset. Everything is there. Your equity builds, but nothing is happening with the cash. You can use delayed financing to get the cash back out of that property and split the assets again. Now you have two assets.
Absolutely. And this is really important today, Cindy, because here's what's happened. Since January 1st of 2022, stock market was down 1,106 points yesterday. Aggregate, the three major index, Dow Jones, S&P 500, NASDAQ Composite, has lost $7 trillion in market capital since January. That's inflation driven. So here's what the concern is, right? We want to look at delayed financing. How many people, especially down in Florida, maybe they're retiring, they're sitting flush in their 401k, they're flush in their mutual funds, they have all this cash. They paid cash because they had all this market cap in their investment vehicles. All of a sudden, 4 months later, they're like, wait a minute, I lost 100,000 or 200,000 or 300,000. I don't have the cash that I thought I would have in retirement. What am I going to do, right? This is where the delayed financing comes in and how we can harvest that equity back out so they have the cash they expected when they paid cash in the first place, right? My investment portfolio has dropped dramatically. I need to recover cash to support my expenses. Natish, what can we use?
Delayed financing. Get that cash back out.
Absolutely. Asset shift again, Cindy. I put all my cash into my property. $7 trillion of market cap disappeared. I need cash. Time to shift it back out. Delayed financing turns one asset back into two assets. I paid cash, two assets into one. Use delayed financing. Now I have my real estate value, which will go up and down regardless of how much debt it has on it. Now I have cash that builds a safety net and make investments. How does it work, Natish?
So once you've paid cash for a home, again, as we mentioned, the cash is tied up in the property. Before you even settle on that home, you can start the loan process and you can start getting that cash back out before you have even settled on that property. Now, as soon as settlement happens and you've gone to closing, you've got the keys to the home, you can finalize the financing for it as well. So you pay cash, get into the home, and then immediately afterwards, you do a cash out transaction and you get the cash right back out to invest in other assets. We've Brett's brought this up a few times during this. The market is down. So why take that money and put it all in real estate when you know the market is down. And what do you do when market is down? That's the best time to invest,
Best
right?
time to buy, dollar cost averaging, right? It's a
Exactly.
great value to buy, yes.
So that is asset allocation. You're not allocating your assets well if everything is tied up in one asset. But if you take that asset, you've bought the real estate, you've got financing on it, take the cash back out, and you allocate that cash in other investments where you know the market's going to go up eventually and build that equity.
It's really important, Cindy, and we're not trying to get too sophisticated on the financial side, but we have to approach things very different in inflation. So somebody that paid cash for a house in 2021 is very excited to do that. I'm pretty sure in their personal financial budget, they weren't thinking they're paying $5 a gallon for gas, right? That changes your cash position, right? I'm pretty sure they weren't thinking about paying increased grocery cost of 15, 20, 30%, right? That changes our outlook relative to the cash I had available and what my monthly expenses are. The other thing that Tisha talked about is when markets correct and they change. Now, it's really important because a lot of people say, well, you just told me the market lost $7 trillion. Yes, it did. But I would tell you, just like real estate, right, which tends to go up in value, actually, I can say with 100%, always goes up in value, but has a ebb and flow within that time period. If you bought a house in 1970, it was worth more in 1980. If you bought a house in 1980, it was worth more in 1990. Bought a house in 2000, it's worth a heck of a lot more in 2022. But when in those time periods, right, did you see it kind of level off, maybe correct? Same thing with the stock market. In October of 1987, the stock market fell below 2000. Everybody panicked. It was Black Monday, and they said, the stock market will never go over 2000 again, as it sits at 35,000, right? So buying opportunities, smart money now as the market corrects, right? You're seeing these people buy stocks at this time when the market corrects. But more importantly, Cindy, I think with our clients, we want to help them understand buying the real estate's important, but we want to give them suggestions that will help them and become a more valued resource to them other than just buying or selling a home, right? You know what? It's important to do that. We pay cash to get the deal, but you know what? Inflation is an issue now. Let me introduce you to the FDM team so they can talk a little bit about delayed financing, learn how you can do this. You have 6 months to do this from when you purchase your property. That's a big time frame, right? That you can now reharvest some of that equity and use that to protect yourself against inflation and use those to create other investments, right? We have to take a different approach. I wish I could tell you I think inflation is going to wane. It is not. I think it's going to get worse. We're probably going to be dealing with this for a while. So our mindset and how we approach this with our clients have to be a little bit different. The reason we want to bring this up, Cindy, it's not just enough for us to help our clients buy or sell their home. We want to let them know we're thinking about their financial well-being. And you know what? You don't have to be an expert at delayed financing. What you want to do is say, I'm going to set myself apart. Cindy, you know what? Congratulations on buying a new home. I'm glad we paid cash to get that deal. But you know what? We are dealing with some unique economic times. There is a new concept out here that can help you protect against inflation. Let me introduce you to Tisha. They can just give you a free analysis of what this means to you so you can make a decision, right? What's the worst thing they can say is no, but you know what? You brought something to their attention that sets you apart from every other realtor, right?
You've got a phrase that I love. It's follow the smart money, right? So it may not be something that we've thought about now, but I'd like to increase my net worth, and this I'd like to always learn strategies to do that. So I think our clients would as well.
Absolutely, Cindy. I'm not that smart, so I just follow other smart people, right? So that's how I've learned to get this. So you know what, Brett, you're really not that smart. So follow what other smart people do, and then you know what, I look okay, right? So you follow the smart money. It's interesting. You watch what they do, right? And you sit there and say, okay, this is what's happening. But, I'll never be Warren Buffett, but I do watch what he does, right? I'm not going to be Goldman Sachs, but I watch what they do. I'm not going to be Citadel, but I can learn from what they do. So right now, when you listen to Wall Street or anything right now, all they're doing is borrowing money because it's going to be cheap. And if it works for them, it'll probably work for me. Now, here's one of the things. Well, I want to be mortgage free. Now, I want everybody to think about this. If I have a house that's worth 500, I have a mortgage of 300, right? But I paid it off and I owe 0, but I put all my money in here. I have my house worth $500,000. However, if I took that same $300,000 and I put it in this account and I can write my mortgage and pay it off anytime, am I still mortgage free?
Mm-hmm.
Absolutely. But over here, right, this cash is banning for me. In 2008, everybody talks about 2008, right? People that paid cash, right, if they sold their property, which I advise everybody not to do, right, they lost money. But if they had their cash over here, guess what was happening? Stock market was going up and other investments going up, or real estate was going down. I was still making money with this asset while this asset went down. You know what that is? Asset allocation, right? I have one asset performing when one other asset isn't, right? So we need to bring real estate into that asset allocation strategy. It's more important today than ever because we got the inflationary pressures that we're dealing with.
Sounds like smart money to me.
Yep, like I said, follow other smart people. Don't listen to Natish and I, but other smart people are telling us to do that. Yep. So follow the smart money, Cindy. That's what we're going to talk about. Call up Natish for your delayed financing analysis, and we'll tell you what works for you.
I'm so hung up on money. I forgot, like, we're at the end of the show here, man.
No, that's okay. Okay. You can't hide it, right? We talk about you can't fix it, you feature it, right? We can't hide inflation. I wish I could tell you it's going to be different. We pay a lot of attention to what's happening in the market. Energy inflation is going to be an issue. Food inflation, because that's tied to energy inflation, right? Everybody wants to know why food costs are going up, because energy is going up, right? It's not. I'm living in 1979 again, and I know you were both probably like 2, but I had gas lines and gas and food, right? So it's just 1979 again. It's awesome, right? So it makes me feel young. So I'm waiting to stand in that gas line. But anyway, that's driving inflation, and that's not going to go away. So what we need to do, help our clients understand, buy with confidence. But here's 1 or 2 strategies that can help you protect yourself about what we're going to deal with over the next year or 2 as we fight these inflationary pressures.
This is one fantastic strategy, but I tell you, Brett, every week when I read your blogs that come through, I'm like blown away at how FDM really has so many products and the ability to guide people to really help restore credit or leverage credit. There's just so many options out there, and I think it's just a really advantageous partnership to be working with you guys. You've really got a lot of people's best interests at heart.
Cindy, we do. Thank you for sharing that. We love our partnership with DF, and Natish will tell you that one of our basic tenets is this, right? We don't believe it's enough just to get a bar approved for you, right? I've been doing this for 37 years, and part of the reason I've been able to last as long as I have is that I've always looked at it and said, it's more than just our ability to get them approved, right? We want to be somebody that can add value, whether it's fighting inflation, or whether it's the positivity of what we need in kind of a challenging market today. So we want to do things more than, hey, I can just get your loan done, because we realize a lot of people can do that, right? So the commentary we put out, we put a lot of research in. We want to try to add value that's something other than, hey, we have good rates, which we do, and we can get a loan approved, right? We want to help our clients and our shared clients, right? Because we believe there's a shared responsibility, make better financial decisions, right? Be confident in their purchases. And as our partnership grows, we want to do things that add value simply than, hey, we can get a loan done. I can get a loan done. Hey, so we know people can do that, but we want to be different. So
That's fantastic. Thank you, gentlemen. It's always a pleasure. We'll definitely push this out to the agents, and we look forward to seeing you next time.
Absolutely. Let's fight inflation together. Let's give people cash. Let's let them pay them off with future dollars. Let's give them some basic economic tools that they can beat inflation, because it ain't going away, but we're going to kick its butt.
Absolutely. All right. Thanks a bunch.
Thank you for joining us for FDM Brews. Our team is here to answer your questions. Just call 239-359-6590 or email us at dfry@fdmhome.com.